Welcome to Oregon Cash Flow Pro. Today we're going to go over the update for our high yield dividend ETF portfolio and how it's doing. We've expanded it quite a bit. I'm kind of excited to share that with you. I'm also going to be talking about where these fit inside of an overall portfolio and how we're treating what happened this last week. The market came down quite a bit on Friday and there's panic in the streets. But first, let's talk about return of capital a little bit more. There's a lot of confusion around return of capital still. I did a video earlier this week. I'm going to link to that right up there. And I show you a concrete example on how some of these high yield dividend ETFs can classify a dividend as 100% return of capital, but they're not actually losing any money. And in fact, it can be really good for us as the investors that are getting the dividend to have it classified as return of capital, and our overall position has gotten a lot better. It doesn't mean that's always the case, so it's important to understand the details and look at the details, but hopefully that gives some clarification there. Adding on to that video, pause this, go watch that video, and then come back here. I'm just going to add a little bit more in regards to tax treatment and what you need to be aware of when it comes to doing your taxes with the return of capital, because it's not very intuitive. If you go to YieldMax website, they have a good flyer on return of capital that has a little bit of an explanation. You can read here to understand a little bit about it as well. And they have a practical example, but it doesn't delve into exactly what I went over in the video that I made earlier this week that will give you a much better understanding of why it's advantageous when we see return of capital in these a lot of times. And then they talk about the long-term effects and zero basis. And this is where it's important to understand that if you have an ETF that makes return of capital distributions over a long period of time, your cost basis will eventually go to zero. They may still continue reporting return of capital as a distribution, but you can no longer treat it as that. You have to treat it as capital gains. So it's important that you track these things. If you continue to drip or to just reinvest your dividends back into that same ticker symbol, your basis continues to go up. And so you will be able to continue using that return of capital distribution to offset your basis as long as it keeps increasing. So this might be something that ends up being a little bit complicated for some people to track. If you're tracking this, if you own these inside of an IRA or a Roth IRA, then it doesn't really matter. For tax reporting, they're going to send out a final 1099 that's going to give you the distribution information with regard to how much of last year's dividends was return of capital and how much was gains. And you're going to use that, subtract that return of capital from your basis, and then your gains are going to be reported. Most likely, they will be short-term capital gains. If you hold your shares for more than a year, they will qualify as long-term capital gains when you sell those shares. So if you keep reinvesting those dividends, your basis continues to go up. You will still have to claim likely short-term gains on the dividends themselves,
at least the portion that's classified as dividends in the 1099. The part that's classified as return of capital will still likely get long-term capital gains.
because it's income, it's actual income. So it makes sense that it's short-term capital gains. It's the same classification as if you were doing the selling of the puts and earning the income yourself with the options. But the shares themselves will carry long-term capital gains treatment if you hold them for over a year, any gains that you make on those. So while you can write off the return of capital on the dividends up front, when you do sell the shares, you're going to recognize long-term capital gains. That's advantageous because a lot of long-term capital gains are a lot less expensive than your regular tax brackets. And some long-term capital gains come at a 0% tax cost, depending on your income. Definitely helpful to talk to a tax professional when you want to get down to exactly what this might do to impact your taxes. Before you do that, you might just assume it's all going to be short-term capital gains. Treat it as such. Set that money aside so you have the money to pay taxes when they come due. And then Any return of capital that reduces that, great. Or if it ends up being long-term capital gains, you've got extra cash on the sidelines that you can go reinvest somewhere. Moving on to our portfolio update, you'll notice there's now 3 dividend income amounts that I list. These are our monthly projections. And our first one, you can see clearly, is Roth. We track that separate than our after-tax brokerage accounts. The second one is our after-tax brokerage accounts, all combined together, except for one. And that one is here. We're tracking this separate because it's part of our 0% credit card challenge, where we're doing a balance transfer. We have some fees for the transfer, but then we get to borrow at 0% for the next year plus. And we're tracking that portfolio with you guys so you can see if we can actually make enough money selling options, purchasing high yield dividend ETFs. Can we make enough money to pay those back and have money left over at the end of the year? We had started adding some of these last week, and then this week we bought the dip. When I show a green arrow on the thumbnail that you see on the video, that means our dividend income went up this week from the prior week. And in all 3 of these, we've got some increases. Next week should be the same because we added substantially this week. We're going to go over that in a little bit, but we also added a new ticker symbol. And we did that inside of the challenge portfolio. And you can see that new ticker symbol here, BITK. As always, if you guys have any questions about these things, put them in the comment section below. I'm happy to answer any questions. And if you appreciate the transparency and the knowledge that we're providing, give us a like and subscribe to follow along. Let's start with an update on our Roth portfolio. You can see the projected income right now at $4,785 for the month. Our cost basis is now up to $70,000. This is up substantially because we added a whole bunch of coyy this last week. We added a little bit of blox as well. I think those are the only 2 that we added to, but it added substantially to our projected income. You can see now we've got 14,000 cost basis on coyy. That's kicking out, based on the current dividend rate, about $2,000 a month. Our biggest position outside of that is lfgy, which we've got 23,000 cost basis, and it's kicking out a little over $1,000 a month. Following that up, ULTY, our 3rd biggest position, we're in for 10,000, and it's kicking off about $655 a month. Then we have xbty, msty, qdte, and blox. Now, an exciting update, yieldmax, their ETFs that are monthly, most of them are going to go to weekly. So msty should start paying off weekly. I'm excited to see what happens with that one. This one hasn't been a very good position for us overall. You can see it's down the most of all of these, but the payback period on this, we still end up cash positive by month 14 or month 15 from now, 15 more months based on the current dividend rate. So it'll be interesting to see how that updates. Here in my spreadsheet, we're tracking multiple brokerage accounts and the dividends that they kick off and the cost basis. And we can see right here, months until money printing, this number is based on the 3-month average, whereas down here, we have it based on the last dividend paid. Those can be different. So like here, lfgy, their dividend went up again this week. The rolling average, 45 cents. Now at 51 cents, it's a 16-month payoff. Or 16 months for that to be pay off instead of 18. qdte, dividend payment is down from the 3-month average. So it's 33 months payback if you use that 3-month average, 36 months if it continues to pay out the current rate. msty, similar situation, dividend dropped a little bit. So 14 months if they get back to the average, 15 months based on the current dividend amount. xbty, dividend dropped quite a bit. So 12 months payback on the current dividend, or on the 3-month average, 14 on the current. ULTY dropped a little bit as well. Still looking at a 14-month payback. Blox, dividend went up quite a bit. We're at 35 months based on the 3-month average, 30 months based on the current dividend rate. And this dividend has gone up the last couple of weeks. So it'd be nice if that trend continues. Coy, the dividend is dropping compared to the 3-month average. So 7 months for the payback on the 3-month average, 8 months based on the current dividend rate. Now check out these numbers. Some of these numbers are really good. Blox has just been killing it. Prior to that drop on Friday, we were up nearly 30% when you account for the dividends. It took a bit of a drop, but we're still in a really strong position here. Coy was also positive, took a big hit on Friday. Now it's down quite a bit, but we added substantially, took advantage of buying that dip. Now, one of the things to think about here, I talk regularly about how I like to treat these as if they're rental properties. This 300 shares of xbty is a rental property for me. It's going to kick off income that's going to pay back the money that we spent to buy it. And once it finishes paying that back, it's all profit. That's the months until money printing. So right now we're at 14 months. If this was an actual rental property, if you could pay back everything you spent in 14 months and then it was all cash positive, that would be an amazing rental property to own. And that's how I like to treat these. So what happens if the neighboring house of a rental property you already own goes on sale? You pick up more. We had coy in the $17 range and we added a whole lot. Let's go to our cost basis here. We added a whole lot at the $15 price. So we've got 200 here. We had 200 here. So a total of 400 added just in our Roth accounts. Reduced our average. Let's take it back. Let's take a look back again. Where did we pick up the other coys? We were up around $20 for most of what we spent on coy. So being able to buy the neighboring property for $15.89 that's still kicking out the same dividend, that's quite a deal. And we're going to expand our rental portfolio with that in mind. Now, this happens to have a really big dividend that should pay back very quickly. If we can recover our cost basis in, let's say, 1 year. Right now, we're looking at 8 months, but let's say it takes the full year. If it continues kicking off over 100% dividend for the next year, that doubles our money. We make 100% return that next year because it's all already paid back to us. So while it might not look very attractive at the moment, we're down 3.76%. This can get very attractive once it pays back our original investment. That's what we're looking for in all of these. Now, blox is a little bit different. This one takes quite a while because the dividend payout is quite a bit lower, but they want to grow the share price and they're very effective at it so far. So while the dividend, they're trying to keep that dividend at about a 36% return for the year. They're expecting to see that NAV grow in addition to that. And that one has been really performing well. LFGY has had a great last couple of weeks. We are really sitting pretty with all the dividends that it's kicked out. Now, it still has 16 months based on the last dividend rate. Still 16 months to pay us back our original investment. But we had a substantial investment in this. This is going to be very nice once we get that paid back, especially if it continues to do as it's doing. Prior to that big dip on Friday, LFGY was up over $38, and our position was really strong. qdte, kind of the same situation. We were up over 14%, maybe a little bit higher before the dip on Friday. Now, we're not planning to add to qdte, mostly because it's a slow payer. I plan to add more to things like this once we get these other ones paid back that are really strong payers. So remember, as far as our overall portfolio, we treat these like rental properties. We have trading accounts where we're going to sell options and we're going to make income that way as well. We have actual real estate and we have IULs where we can get growth from the market without the downside. That's an index universal life policies. And I have whole life policies that act like a bond replacement where we're just going to consistently get over the next 30, 40, 50 years, where we're going to get 4, 4.5, 5% as an internal rate of return. That's a great bond replacement. So we have all of those. And then I also have some long-term positions in the market that I basically ignore. But essentially, it's good to have a diversification because when a day happens, like what happened on Friday, we didn't need to panic. We don't need to worry. I'll go over more of our instant reaction to that in my 0% credit card challenge update, because that one we're revealing the whole portfolio and you can see what we did in reaction to the movements. And we actually got a big assignment over the weekend. So that one's going to be interesting to see what happens on Monday with that one. Let's take a quick look at the dividends paid out. These are our dividends for each week. Here's where they look in chart form. And I added this here so you can see all dividends received. We're over $10,000 now that we've received since we started these inside of our Roth. And then here's what it looks like for each ticker symbol. We've got the dividends earned, the current value, the total return, and what is that in relation to the cost basis. And then we have it in graph form. LFGY just crushing it, where we're well above our cost basis. QDTE also. Now, prior to Friday, every single one of these was above it, other than msty, I think. So we did take a bit of a hit on Friday, but we're not panicking because these are rental properties. What happens if you own a rental property and the actual pricing of the housing market goes down? If the values of the houses in the neighborhood that you bought go down, do you panic? No, because rental properties aren't as liquid as these are, and you don't get to actually see the price change day to day. All you know is it's continuing to kick off the same rents. Now, in here, the rents are going to vary and they're going to adjust, but on average, they're going to be fairly consistent from what we've seen so far. And that's why we bought the rental property, is to kick off rents. So just because the underlying value goes up or down, we don't worry too much about it because we're not planning on selling them. If we do plan to sell, it's going to be for some other fundamental reason. Something changed with regard to the position that we're holding. Now, once these are all running on house money, I probably will never sell these. There's not really a reason to sell them unless the dividends just get so low and the shares are still worth enough that I could buy something else that's kicking off a bigger dividend. But when it's all profit, it doesn't really matter that much at that point. It matters a little bit if we want to optimize, but you're still going to continue to carry and hold your separate rental properties. It gives you some diversification and protects you a bit from the drops in the market. If I had everything in msty or xbty, this would not have been very attractive after Friday. Those ones took a bigger hit. Same thing with coyy. Coyy took a pretty big hit. If I had everything there, I might be looking at this a little bit differently. But because we're diversified, we're still positive after all the dividends. And when we look at the values, the current values of all of these properties still, in general, pretty darn happy with this. Let's see what our diversification brought us over here. Yieldmax now only 53% of our portfolio here on the Roth accounts. Round Hill at 8%. Granite Shares jumping up to 29%. That's because Granite Shares has xbty and coyy. Those are our two big positions outside of Yieldmax. Yieldmax holding ULTY, msty, and lfgy. And then we've got Nicholas Shares, 8.52. That's blox. Really happy with that one. I want to expand that one, but the payout is so low, and I'm really focusing on increasing our payout at the moment, that we're going to go a little bit slow. We will want to buy some of the dips, and we did buy a little bit, but it really hasn't dipped. So if it does dip some more, maybe we pick up some more blocks. That's a strong one, though. Let's move over to our after-tax brokerage accounts. These are our after-tax brokerage accounts, not counting the 0% credit card challenge one. So we're up at 49,000 now with what we've purchased. We are positive 5% after the dividends we've received. So current value of all the shares, 44,800, but we've received almost 7,000 in dividends. You can see our lfgy position just doing really strong, also looking good. Blox over here, because we haven't added to it at all, really high percentage since we first bought it. Like, it's just been crushing it. ULTY, still in the positive, but hanging on by a thread. We're still 15-month payout on ULTY, 15-month payback. xbty and msty, the big losers, but xbty really took it this last week for some reason. We'll see if that one bounces back and what it takes to bounce back. But the payout is still really good, even though it's dropped quite a bit It's a 14-month payback. I think we can wait that one out. Coy, we're up to 379 shares of coy in here. And we've got an 8-month payback based on the last dividend. 7 months still based on the current 3-month average. And then we have gdxy and bito. gdxy just crushing it as well. This one paid out a recent dividend, and the share price is still higher than our cost basis was. So like that one a lot. Bito was also doing really well, but it dropped like 4% on Friday. And it's only barely under our cost that we've paid, but we received a bit in dividends. Now, the dividend that it kicked out did go down a little bit, but gdxy, the dividend went up a lot, substantially from the 3-month average. So that one, if it can hold there, 14-month payback. Whereas Bito, looking at 24-month payback. Current dividend income here, $2,864 a month. And let's look at those distributions. $756 for the week. That's because gdxy paid out. It's a monthly distributor. Here's gdxy. And then we had a bit of an increase from lfgy. And we added some coy. Let's look at that cost basis real quick. We added 90 shares of coy. Oh, that one didn't kick out the dividend yet for this week, though. We just added that on Friday, buying the dip. Here's what it looks like in the graph where we're tracking the dividends earned, the current value, total return, and our cost basis. Really like how this one looks. And let's look at the diversification. We've got yieldmax at 45%, Roundhill at 20%, Granite shares at 22%, Nicholas at 7%, and Pro shares at 4%. This one is a really nice diversification. I like where we're at in this portfolio. Now, let's see this one. This one's kind of exciting. We hold 3 positions in our 0% challenge portfolio. These are after-tax brokerage accounts. We've got blox, coy, and we added bitk, which is another one with Bitcoin. This one just launched, and its initial payout was $1.50, and it's a weekly payer. Its second payout was 50 cents. Now, we didn't get either of those because we just bought it, and we happened to buy it right before the dip happened on Friday. So we're down a bit right out of the gate, but we'll see what this one ends up doing. I will probably add to this position because I like that potential payout. If it continues at 50 cents, that's good enough for a 13-month payback. If it jumps back up to $1.50, oh man, look out. That was like a 6-month payback. Okay, coy. We doubled our position at the dip on Friday. Here, let's look at our cost basis here. You can see we added 300 shares of coy on Friday. Now, we also had added 200 shares of it before the big drop happened. We added those at $17.50. And then we added the bitk here. So we didn't add any blox. No, we did. We added 100 of blox here also before the drop happened. All in all, blox still positive though, even though we added some shares to this position. And coy, just a little bit negative. But we're in a strong position to start making money on this thing quickly. Ultimate monthly dividend, $1,800. And the dividend payout per week is climbing. Next week is going to really jump up because we added all those shares this week. I've got the wrong dates on this. I need to update that. I'll do that after this video. These did not start on that date. It should be right here. It should be these dates. And here's what it looks like. We've got our dividends earned, current value, total return, and cost basis. Only blox above that cost basis so far. But this one's going to be an exciting one to watch. That's all I've got for you for the H.Y.D.E portfolio this week. Again, if you have questions or comments, put them down below. If there's something that's on your mind that maybe I haven't thought of, or you got any tips or tricks to share with our listeners, put them in the comment section below. If you need this spreadsheet, it's available to our Discord members. I've updated it quite a bit over time, certainly since we picked it up. It originally came from Dividends on Repeat. They had this, and it can handle one brokerage account. But we added the ability to add multiple brokerages, tracking the cost basis across multiple brokerages, and we added the charts for the dividends where you can see how it looks in chart form. So if you want that, you're going to have to join our Discord. That is available to anyone who becomes a YouTube channel member or a Patreon, and it's just $1. So we're not doing it to try and make a bunch of money. We're mostly just keeping the trolls out of the Discord. But if you want over there, I'm available in there. You guys can always ask any questions, and that is my priority for getting things answered. And then, of course, we answer anything that shows up in our comment section here on YouTube as well. Appreciate you all, and we'll see you next week. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.